Okay, so welcome everybody, and Kathy, welcome. Thank you so much for joining us. So we are very excited to have real estate entrepreneur and media personality Kathy Fettke present to us today. Most of you will probably already be familiar with Kathy, and a lot of you have probably heard her speak at various real estate events like Jay Martin's event or other events, or maybe you're subscribed to her podcasts. I know I am. For those of you that are not familiar with Kathy, she is the CEO and co-founder of the Real Wealth Network and the host of the Real Wealth Show. Kathy is an active real estate investor, licensed realtor, certified coach, and former mortgage broker. She specializes in helping people build multi-million-dollar real estate portfolios through creative financing and smart planning. And Kathy is frequently featured in the media. She's quite the celebrity, actually. You can look her up. She's been on CNN, CNBC, NPR, CBS Market Watch, Wall Street Journal, and Fox Business, and many more other shows. She is passionate about learning about the different facets and aspects of real estate and sharing that information with the members of the Real Wealth Network and the listeners of the Real Wealth Show. If you want to learn more about Kathy and the Real Wealth Network, we invite you to visit realwealthnetwork.com. And tonight, Kathy will help us better understand opportunity zones, or OZs for short. OZs allow savvy investors a range of unique tax advantages that are possibly one of the most profitable opportunities in our investing career. So you'd want to pay attention. OZ rules, however, are pretty involved. So you want to pay attention to that too, because you need to find out if and how you can benefit from this historic opportunity. So before we turn it over to Kathy, I think Ryder has a few remarks about a cool event that we have coming up. Ryder, tell us more.
Yes, thanks, Chris. And what an intro. Wow.
Yeah, I talk, I do that.
Also wanted to mention your book. You gave the book out at the Jay Martin event. I read that. Even my wife read it like in a weekend. So really
awesome.
loved it.
That's great.
But yeah, Chris mentioned, I want to give a shout out, and this is actually a referral that you gave us, Clint Coons, who we adore. He's come to the event, he's come to the meetup, he's done some webinars. I think he did one about 2 weeks ago on tax strategy and asset protection. So he does these workshops that are, awesome. It's a 3-day workshop. You can learn basically at least the foundations of tax strategy and asset protection. And he usually does them in Las Vegas, but he's doing one in the Bay Area here around near us in Burlingame on August 9th through the 11th. It's 3 days. He's hooking the VIG up with the special offer. So it's $197 for 3 days, which is insane. Absolutely insane.
That's for 2 tickets, actually. So you can bring a friend.
Yep. It's awesome. So, day 1, he'll identify threats in wealth accumulation. Day 2, he's investing in real estate with IRAs and 401ks. And then day 3 is real estate business strategies. So it's awesome. I know I'm planning to be there along with my wife. Chris, are you going to make that one? Or
I'm definitely planning on it. Yes.
Cool. So yeah, we're looking forward to that. You can learn more about it on the meetup page, as well as our website, vigsf.com, and it's right in the header. We've got it promoted. All right. So with that out there, Kathy, please take us away. Tell us all about these lovely opportunity zones.
All right. Well, Clint Coons actually also helps people set up an opportunity zone fund. That's what we've been doing, because it is it's a complicated tax structure and tax benefit. Got to do it right, or you lose the whole benefit. So he is setting up those opportunity zone funds for our members who just maybe want to have their own or invest in others. So that's kind of a plug for him too. He's awesome. Okay, so I don't know. I haven't done this before, but let's see.
Hey, you nailed it.
Did I do it?
Yeah.
All right. Okay, let's come up here to the beginning. That's a good place to start. And I will start with this disclaimer that I am not a CPA. There's going to be a lot of tax information in here, so don't take my word for it by any means, and don't rush out and start an opportunity zone fund or invest in one just based on the information I give today, because this is really going to be just an overview. There are so many details to this that I don't want to get into that. I'd rather have a CPA do that, like Clint Coons. Maybe he'll even add that to his presentation when he comes out. You can get slides at slides@realwealthnetwork.com. Just shoot an email over, and if there's any slides here you want, you can get it from, it'll come to you on the email. So opportunity zones, there's a lot of them. They're all over the country. Look at that. And they're in very surprising places like downtown LA, Hollywood, downtown Phoenix, the Trick Center in Reno, the largest industrial center in the country, and somehow that's an opportunity zone. So these are supposed to be distressed areas, and the governors were, they picked out the areas that were designated opportunity zones, but it was based kind of on an old map. And a lot of these areas have already been gentrified. Like I said, Hollywood, parts of Hollywood, it's like, are you kidding me? This is an opportunity zone. Whereas the real opportunity zone should be Compton or something, which it is. But a lot of investors are choosing to go into the areas that have already started their gentrification or are already done. They're already really nice. So there was definitely some politics that went into picking these zones. And I think that's the key, is really just to look it up. You can just Google opportunity zone map. And if you live, wherever you live, you could type in San Rafael and you'll probably find an opportunity zone there, or San Francisco. And you could be very surprised at what you find. I was looking at buying a property in Chico, California before the fires. I wish I had bought everything because now there's such a shortage of housing there and prices have gone up enormously. But right in the center of Chico, I mean, literally just walking distance from downtown, there's a whole opportunity zone there. And so incredible locations, but you do have to be careful about the location you choose if you're going to invest. So what this is, it was part of the new tax law, and the idea is to have investor dollars go into areas that investors have been a little bit more concerned about going into. So these are distressed areas. They're supposed to be. Like I said, many of them are not. And the idea was that instead of investors going into another high-rise in downtown Chicago, San Francisco, or LA, that it would go into these areas that need those investment dollars. And by doing that, you would get a big tax benefit. It's a little bit like the GO zone, if you remember the GO zone tax benefits back in when Hurricane Katrina, gosh, I don't remember the year, but after New Orleans got wiped out from Hurricane Katrina, there was a tax benefit called the GO zone. And if investors went in and helped rebuild that area, they got enormous deductions. So that's what this offers to investors today in an attempt to bring certain areas up and to bring investor dollars and businesses into distressed areas. So here are some of the tax benefits, and many people are saying it's the best ever that's been offered to investors. I'm still on the fence. We started a fund, but we haven't launched it yet because of the intricacies. As a fund manager, you have got to meet deadlines and do it right, because if you miss anything, and you will be audited twice a year, people could lose the benefit. And boy, if you raised millions of dollars and weren't able to give the tax benefit that was expected, you'd be on the hook for that. So don't just jump in and start an opportunity zone fund. And the same thing goes, don't jump into somebody else's opportunity zone fund. A lot of people jumped on this, but a lot of people who jumped on it weren't necessarily real estate experts. So like any investment, the tax benefits are only as good as the investment. So if it's a bad investment, there's no benefit, tax-wise or otherwise. If there's no gain, if it's a bad project, there's no gain and no benefit. So got to be really choosy and let the tax benefit be just icing on the cake always, because taxes change. The tax law changes. So always choose your investment based on the quality of the investment, and the tax benefit is just that extra bonus. But on this, you get the gain deferral, you get the partial forgiveness, and forgiveness of additional funds. So let me explain it, and I think a lot of people want to know, how does it compare to a 1031 exchange? And it's a really important question because we already have amazing tax benefits as real estate investors. We already have this ability to sell a property and buy another property and 1031 exchange it and pay no gain on the property you sold. And then you can basically 1031 exchange until you die, and then the property steps up to market value when your heirs inherit it, and they don't have to pay the tax. So that's the tax law now. Again, that can change. But the 1031 exchange is still an incredible option for people. But it's also not always the best option, especially now that opportunity zones exist. Let's talk about the difference. If you had, let's say you had a $100,000 property. Let's say $1 million, since we're talking to a San Francisco audience, you're not going to find a $100,000 property. But let's say you've got $1 million property and you sell it, and you want to, say, come to Real Wealth Network and buy 10 properties nationwide. So you want to take that one property in San Francisco and diversify and 1031 exchange into, say, 3 properties in Texas, 3 properties in Florida, maybe 3 in Cleveland or Detroit to balance out the portfolio. You can do that and not pay any gain on that $1 million sale and buy $1 million worth of replacement property. You can refi that and kind of refi till you die. And again, your children can inherit those properties. They step up to the market value, and you don't have to pay the tax ever. So I kind of don't think anything beats the 1031, but the opportunity zone has other benefits. So it doesn't have to be like kind, and this is different than 1031 exchange because it does need to be like kind. And what that means is you can't sell that $1 million property and invest in a fund. We have syndications at Real Wealth Network where we acquire land and we build homes, and investors become equity partners and they make a 15% preferred return. It's totally passive. You don't get to do that with a 1031 exchange. It has to be like kind. So if you sold a property, you have to exchange and buy another property. You could sell one property and buy 10. Like I said, you could sell $1 million property and exchange it into 10 $100,000 properties. Or you could take that $1 million property and exchange it into a commercial building or an apartment. But you can't invest it in a fund or a stock or something like that. And with the opportunity zone, it doesn't have to be like kind, and that's really unique. So basically, it's not just real estate, and that opens it up wide. So you could sell your stock, you could sell a business, and the capital gain you would pay on that you really up till now haven't had a lot of choice, but you just have to pay that capital gain. Well, instead, you can invest that gain into an opportunity zone fund, and you can't 1031 exchange like that. So that's the big deal to me. I think if you want to cash in your stock or your stock options, or you're like I said, you're selling a business, I would definitely look at the opportunity zone because it's the first time I've ever seen anything like that. But if you're selling the property, then it's still a 1031 exchange might be more interesting. All right, so with the opportunity zone, basically you could just take the capital gain. You don't have to take the whole thing. So if you sold $1 million worth of stock and you had to pay 20% capital gain on that, that's $200,000. You could just invest the $200,000 instead of the whole $1 million. Whereas with a 1031 exchange, you got to invest the whole thing. So that's a big difference right there. Again, if you sold that $1 million property, you got to buy $1 million worth of replacement property in the 1031. But in an opportunity zone, you just take the gain. So you can pocket the 800 grand and just invest what you would have had to pay in taxes in the opportunity zone. And if you take that $200,000 gain and invest it in an opportunity zone, you don't have to pay tax. And if you hold it for 5 years in the opportunity zone fund in the property, then you get a 10% discount on the tax you're supposed to pay. And if you hold it 7 years, you get an additional 5, but you have to invest this year. And if you hold it 10 years, that's when the massive benefits come in. And that's where the new property and the new, in the opportunity zone, if you hold it 10 years, you pay absolutely no capital gain on that. But you do have to pay the $200,000 gain by 2026, whereas with the 1031 exchange, you don't ever have to if you keep deferring. So I hope I haven't lost you. I've got some pictures to show it. It's a fairly complicated topic, but I do have some graphs I think will make it easier. So I'm going to click out of that. Now, again, here's some differences between the fund, Opportunity Zone Fund. I'll call it a QOZ, because Qualified Opportunity Zone Fund, versus the 1031. So you have to buy in a qualified opportunity zone. If you sold that $1 million property, you have a $200,000 gain, you have to invest that $200,000 in a qualified opportunity zone. Whereas with the 1031 exchange, you can invest anywhere. There's in the opportunity zone, there's no requirement on replacement property identification, but you do have to close in 180 days. Whereas with the 1031 exchange, if you sold that property today, you have 45 days from today to identify replacement property. And you have to identify the right property, because if you end up not closing, and this is one of the big risks of the 1031 exchange, if you identify those 10 properties you want to exchange into, during that 45 days, you say, these are the properties I want. But then after inspections or whatever, you decide, oh, I only want 9 of them. Well, you blew it, because you listed that as the property, and then you end up not buying it. So you're going to have to pay tax because you didn't list enough properties in that identification time. So the key there is to always over-identify with the 1031 exchange, so that if something fails and doesn't go through, you still can fulfill the exchange. But you have to close in 180 days. With the opportunity zone, you get 180 days to figure it out, and you don't have that, you don't have to worry about those 45 days. So that makes it a little bit easier. And again, I already mentioned this, but with the opportunity zone, if you sell that property, you only have to take the gain and reinvest it into an opportunity zone. You can keep the rest and pocket it. But with the 1031 exchange, you got to exchange the whole thing, the whole $1 million. So what exactly is a gain? It's the capital gain is just basically if you bought a property for $500,000 and it appreciated to $1 million, then you have a $500,000 gain, and you have to pay tax on that. So you let's say are in a 20% tax bracket. Again, that would be $100,000 you'd have to pay in tax. With stocks, it's the same thing. It's basically the thing that's questionable about the opportunity zone is that capital gains tax is still pretty low. So some people say, it's not worth the effort. I'm just going to pay the 20% tax. But if you invest it into the right thing, it can really pay off. It could really pay off. We'll talk about that. Another thing is capital gain can come in phantom income, which is what happens a lot on our syndications, and is kind of a bummer. But basically, if there's been a sale, but you didn't actually get the money on that sale, but you still have to pay tax on it, that's called a phantom tax. So an example is, I'll say our Reno project. We, as investors, we pooled money and we syndicated. In Reno, we bought, I think it was 170 lots or something. And we raised $13 million. And we acquired the land, entitled it, and then started building the phase 1 of the homes, because we didn't get financing. We just bought the homes. We sold all those homes in phase 1 and used that money to build phase 2 of the homes, to kind of keep costs down and not take on debt. Well, unfortunately for the investors, because we sold that first group of homes, they got taxed on it, but we didn't give them any money back. We used that money to build phase 2. So here they are getting this tax, even though they didn't get their money. They don't get their money till the end. So what's interesting about the opportunity zone is that you could take that phantom tax and invest it in an opportunity zone. So something to think about if you're invested in a syndication that does something like that, or if you have any phantom gain. Okay, so let's talk about the period of, talk to your CPA too. I'm not an accountant. Run all this by Clint Coons. All right, so here's how it works. If you sold, again, if you sold that property, I don't know if my mouse works here, but if you sold that property this year for $1 million, and you had a $200,000 gain, you would have to pay that tax by 2026. But because you held it for 7 years, then you get a 15% deduction on it. So 15% of 200,000, you get like $30,000 off of what you have to pay in tax if you hold it for that 7 years. So that's one benefit right there. The other benefit is that you took that money and you invested it into a property in an opportunity zone. And if you hold it the full 10 years, then that new property, maybe it went from $200,000 to $400,000 in that time period. That extra money, that $200,000 gain you got on the new property, you don't pay any tax on. So right there, that's another $40,000 deduction, or the tax you don't have to pay. So it works out in the end if you can find a property that really increases in value, and that's the whole key to the opportunity zone. You have to find a property, add value to it, and then you'd be able to keep all that upside tax-free. So this is not a cash flow play. You're not looking to just buy a property that cash flows. You really have got to improve the property, and that's one of the rules. One of the rules is you have to put the same amount of money into it as it cost to purchase minus the land. So if you bought a $200,000 property and the land was worth $100,000, well, you'd have to put another $100,000 into the property to improve it. So that's one of the rules that could be challenging, could be very challenging. There's a lot of rules. I go to the Opportunity Zone Expos, and it's a lot of rules. So you want to really make sure you've got somebody guiding you through this. But if you do, there can be huge benefits. You just have to make sure you've set aside the money you need to pay taxes with in 2026, because remember, you've invested it. It's tied up. So some people are saying, well, you could take that gain, buy that property, fix it up, and then refi by year 2026, and then take that cash, the cash out, and pay the taxes with that. So that's one way to do it. It's also becoming very difficult for people who buy apartments, because imagine that if you had to improve the property by what it cost for you to buy it minus the land. I mean, you'd have to do a major renovation. So most people are saying, I'm not going to do a value add apartment. That's too hard. And you have to get it done in 31 months. That's another one of the rules. Again, check with your CPA on that. So that's a lot of pressure. So a lot of people are saying, you know what, I would just build it. If I was going to do an apartment, I would just build it and that would count. Or just build a new house and that would count. We were tied up. We tied up some property right in Reno near that Tahoe Reno Industrial Center. We were going to build a 200-unit building there. But my developer partner just kind of freaked out, because he's like, what if we can't get this done in 30 months? You know, it's if you can't meet that deadline, you could really blow the whole deal for your investors. And so we just backed out, unfortunately, because it was a great deal, and I was bummed to not do it. But it would even be worse if in 10 years they didn't get their tax break they were expecting. So there's challenges to it, but again, there's rewards too. So the lesser of the amount of the gain deferred or the fair market value of investment in qualified opportunity fund minus the taxpayer's basis in the qualified zone. So this is kind of interesting, because with that tax, I mean, again, talk to Clint, because he explains this really well. But with that tax, if the value of the property that you bought goes down, doesn't go up, then you do get recognition for that when paying taxes. So that's good. All right. So again, here's the time frame. Basically, you have your base is increased by 10% if you hold it 5 years, and your base is increased another 5% if you hold it 7, and so you get that 15% discount. And these opportunity zones are in effect through December of 2028. So there's time to figure this out. You don't have to rush into it, but a lot of people are rushing into it this year. And I think making mistakes, that's why we slowed down. We have a fund all ready to go, but we just slowed down. So we wanted to make sure all the regulations were out, and they were not out because of the government shutdown and because of delays. This has been out for a year and a half, but the first set of rules didn't come out till last October. And then the second half, I think in April, because of the government shutdown. And then we just had another set of regs come out. And so, again, that was one of the reasons we didn't pull the trigger on that apartment, because the rules weren't out yet. So, you don't want to gamble with other people's money. That's for sure. I don't anyway. But we have time. You have until December of 2028 to figure this out. The thing is, if you were to invest in an opportunity zone in 2028, you're going to lose that 15% discount that I said. If you hold it 5 years and then 7, you get that 15%. But you still get the other, where if you hold the new property for 10 years, you get it tax free. Boy, I hope this isn't overly complicated. It's a lot. Now, the only way you can do this is it has to be a fund. So you can't just put it in your name. It has to be in a qualified opportunity zone fund. And that fund is just basically a corporation or partnership. It can't be an individual. And the purpose of it has to be to invest in an opportunity zone. It has to state that in the documentation and when you file. And then it has to go through an asset test to prove that the money that is in that fund is being at least 90% invested in qualified opportunity zones. And then there's a certification process. A lot of that is pretty simple to set up. And again, Clint Coons is doing that for our clients. He's helping people set up their own opportunity zone fund. They just need another partner. And that partner can be a spouse. So it can be you and your spouse. Just open up literally an LLC. It's no different than really any LLC you might have. But you would have a professional do it. They open up the LLC. In the operating agreement, it states that it's an opportunity zone fund, and it's filed that way as a partnership. And then you can have your own. You don't have to take other people's money. You could sell that $1 million Apple stock and put it in your own opportunity zone fund, and then invest in properties that really need some deep rehab or brand new. We have at Real Wealth Network, we kind of specialize in that. We have teams across the country that help investors renovate properties. So our Tampa team and Chicago team, I think the Atlanta team, and Detroit and Cleveland, they have already been working in opportunity zones, but before they were opportunity zones, they were working in these value add places. So basically, if you're really looking to get a capital gain, if you're really looking to see your investment grow in value, you want to be right on the fringe anyway. So if there's an area that's been redeveloped or gentrified, and then a street away it hasn't yet, well, that's the kind of thing we love to do. We want to buy that street, on that street that hasn't gone up in value yet, but is in the path of progress. So that's our business plan anyway at Real Wealth Network. We've been helping investors get right in front of that path of progress for years. So our teams across the country, they already own these areas. Like they already have their property management in these areas, and they already have their construction teams and their entire teams, their wholesalers and everything already in these zones. So we just told our members, hey, we'll just go talk to our teams, get your LLC set up, designated for opportunity zones, and let these guys help you find the properties, renovate them, and rent them out. So that's a way to kind of do it on your own with the help of teams in those areas. But again, you might find an opportunity zone in your own neighborhood that you don't need to necessarily buy out of state. It's just that a lot of times the numbers work better out of state. It's kind of hard to do $1 million fixer in California. And believe me, Rich and I have done it way too many times. It's very stressful to have $1 million property that's a dump that you fix up, have to put another $1 million into. Anyway, it can be done. You got to have the money. Or you could do it in Detroit where it's $60,000 or maybe $30,000 and $30,000 in rehab. It's a little bit easier to make those numbers work. And in Tampa, I think we're getting lots for 30, even like between 10 and $50,000 for the lots, and the houses are like 150,000 to build, and the rents are really high in a very hot emerging market. So I like those numbers better than California. Anyway, so again, here's some of the rules. There's lots of rules. Make sure you understand them, or make sure your advisors understand it when they set this up for you. You must hold at least 90% of assets in the qualified opportunity zone property. Now, I'm just going to be talking about property, but businesses can get started in these opportunity zones too. So I just read an article today, and I think this is really interesting, that it said, watch out, Silicon Valley. Tech startups are going to move their operations to opportunity zones. Because imagine that. This is where the opportunity makes more sense to me than just property to property. If you're selling a property and buying another property, I would just do a 1031 exchange personally. But if you're starting a business, or you're selling a business, or you're selling a stock, definitely look at the opportunity zone. So here's what the article said today, and I thought it was very interesting. That imagine, these tech companies that end up going public or end up getting bought for millions of dollars when they're not worth it at all. But these companies that become unicorns overnight and they're valued at $1 billion. Imagine if you started that startup in an opportunity zone and you didn't have to pay capital gain tax on that in 10 years. So that's very interesting. And this article said, watch out, Silicon Valley, because tech companies are going to move to opportunity zones. So there could be an impact to certain areas where maybe those businesses want to move somewhere else, because they don't necessarily have to be located. They can, in the Silicon Valley, they could be located anywhere, or in New York or LA. So that's kind of interesting. Hey, if I owned property in the Silicon Valley, I'd probably be selling it anyway because it's overpriced. Prices are starting to soften, and it's reached a ceiling. Why not sell and diversify and get your money somewhere else where tech companies are going? All right, so a qualified opportunity zone business, a trade or business in which substantially all the tangible property owned by the taxpayer is in the qualified opportunity zone business property. This gets a little complicated, so I'm gonna skip that. If you do a business, it can't be a sin business, what they call it, which for whatever reason, a golf course is included in that. Country club, massage parlor. Massage parlors I go to aren't sinning, but anyway, yes, some do. Hot tub facility, suntan facility, racetrack, gambling, any store that where the principal sale is alcohol. So no, liquor stores, but a grocery store that sells alcohol, I think is okay. I think it's a gray area. But we're going to talk about, property. So you can't acquire it from somebody who's related to you, and you can't use your own property. So if you just happen to own a property in an opportunity zone, that's not going to work. You have to acquire it. So you might sell it to a friend or to an entity. So there's ways to kind of get around that, and I would talk to your advisor, but yeah, there's rules around that. During substantially all of the holding period, it has to be, the business has to be there in that qualified opportunity zone. With property, that's easy because it is there. It's hard to move the property. But if it's a business, you need to keep that business there for 10 years. Okay, I just wanted to show this slide because I think this is important to those of you who are in the high-priced San Francisco Bay Area. This is a slide I show people from 2006. I've been doing this a long time, but back in 2006, we saw the same kind of dynamics that we're seeing today, which is properties that don't make sense. I've had people come up to me and tell me things like, hey, I just bought a fourplex in Berkeley for $2 million. Was that a good idea? And I'll say, well, how much is the cash flow? And they'll go, I don't know. So the only reason they bought it is they thought the prices would go up, I guess. And I look at that and I say, okay, it's probably cash flowing, but that cash flow is probably negative cash flow. And it's probably sitting on a fault line. And I bet you don't have earthquake insurance. And if you do, well, then that's even more negative cash flow because earthquake insurance is expensive. So there's just a lot of people doing things that don't make economic sense. And prices have just hit a ceiling. So there's a really incredible opportunity today, just like in 2006. If you look here, 2004, 2005 was sort of the peak of the last bubble. And this blue line is U.S. home prices. The red line is the home price growth in Texas at that time. So Texas prices were not going up. U.S. home prices went up like a mountain peak. And California was up in the 500 range. So home prices in California had gone up above where it says Texas. So at the time, I had Robert Kiyosaki on the Real Wealth shows. I've had that forever too. Man, I feel old. But I interviewed him at the time, and he said, California is way overvalued. It's the best time to cash in, sell high, and buy low. Sell high in California and buy low in Texas, where prices hadn't gone up. Now, everyone thought we were nuts when we started advising people to do this, to sell their California properties and 1031 exchange them into Texas properties. Because they're like, why? Look at, if you were standing here and didn't know what was coming, you would look back and say, whoa, look at all this money that can be made everywhere except Texas. I mean, Texas is boring. Look, nothing's happening there. So if you were looking at it from that standpoint, it would seem dumb. Like, you're not going to make any money there. And that's what people would tell us. But we trusted Kiyosaki, and Rich and I went, refied our house and bought 5 properties on the first time we went to Texas, and then another 5 the next time. We ended up with like 14 properties. We cashed in. And I helped a bunch of other people do that. I helped a lady sell 3 Stockton properties for $420,000 each that rented for $1,200 each. And we got her into 9 brand new properties that also rented for $1,200 each. So she tripled her cash flow. And then those properties ended up, see here, going up in value because of the job and population growth in that area, which is why we chose that market. And it had been a flat market because of all the growth. It became a growth market. And so this woman sold right before the crash. She sold right here. The person who bought her property in Stockton, basically that property was worth about $75,000. They bought all 3 for $420,000 each, and all 3 were worth about $75,000 after 18 months or so. While she had cashed out and was sitting on properties that grew in value, she did not even feel the recession at all. She was able to quit her job and enjoy the cash flow and just ignore everything. So a lot of people are saying, well, where should I do this today? I mean, there are opportunity zones everywhere, but not all opportunity zones make sense. So kind of what we're following is the same kind of trends that we were following 10, 15 years ago to avoid the last recession. Follow the jobs, follow the jobs. So it's hard when you live in California and you need to rely on a team elsewhere because that's where the jobs are going. But I assure you it's worth it in the end. Unless, again, you can find a really good deal in your neighborhood and you can make the numbers work. It just takes a lot more money. But Austin is the #1 place where jobs are in excess of the pre-recession peak. Lots of tech jobs moving there. Nashville is booming. Dallas, of course, is still hot. San Antonio, I mean, look at all these, places. And then you go to the bottom, Los Angeles down there at the bottom, San Francisco, is it on there? But yeah, just kind of give an idea where the jobs are going. And then where the people are going. These are 2 metrics you got to look at, whether you're buying in an opportunity zone or not. Where are people going? I mean, you could find the best deal in the world, but if no one lives there and no one has a job there, then it's not that great a property, no matter what the tax benefits. So projected household growth by region until from 2016 to 2025, mostly the Southeast. This is John Burns Real Estate Consulting slide. If you look at that massive growth to the Southeast, that's a clue. That's a clue where the population is headed. And for some reason, Texas and Florida are not included in that Southeast, but if you combine them, they couldn't fit that on the slide. The Southeast, Texas, and Florida. There's just so much massive growth going out there because of no state income taxes, low home prices, and job growth. Southwest is doing pretty well. Northeast is okay. California, it's all right. Northwest, not last on the list, basically. So A lot of people are interested in Portland and Seattle, and there are great opportunity zones there, great opportunity zones on the water in Seattle and downtown Portland. But it's important to understand that that's not where the growth is headed per se. But if you love those areas and it's closer and you want to be there, you can make it work out. So you might be wondering, well, is it dangerous now to do anything? You know, what's happening in our economy? I did a full 2019 mid-year housing review and economic update that I think you can find on YouTube. You can also find on the Real Wealth Show. Jill posted it there. And then on our website at realwealthnetwork.com under the Learn tab. That will maybe give you some confidence that we most likely won't be headed into a recession this year or early next because the Fed is lowering rates, and that's going to stimulate things for a little bit longer. President Trump would like to be reelected, and I don't think he's going to allow a recession during his at least until he's reelected, right? During his campaigning, he's not going to be fighting a recession. So looks like the Fed is going to lower rates, stimulate the economy probably for another year. After that, who knows? So just, you have to be careful moving forward. But some of the things that we know is that there's massive household formation. Population growth is over 5 million more people than we had. 20 million more people than we had the last boom and the last bust. So more people. Those people are working. They are getting higher wages. Wages are up. And so they're forming households. Ooh, I'm going to sneeze. Hold on. Oh, I think it went away. Okay. So, but they're renting. It's interesting. There's still an increase in rental demand and also for single and multifamily homes. And that's interesting because there's household growth, but rents are increasing. Rental demand is increasing. So why? And again, I grabbed this slide from my presentation, but the bottom line is it comes down to debt. So even if you have wage growth, you can't qualify for a home if you have a bunch of debt. And we've got students with massive debt. It takes 21 years to pay off a student loan. There's 44 million borrowers today. We have the biggest student loan debt we've ever had, $1.5 trillion. And it takes 10 to 20% of these kids' income once they get out of college to pay the loan. They can't, there's no room in there to qualify for a house with debt to income ratios like that. Back when I was graduating from college, it was only 5%. It was easier. So it's forcing, it's not that people couldn't qualify because their wages are good, credit's pretty good, but the debt is just wiping them out. And then add to it, they just walk in and they could just go to Boulder. Out of state students pay $55,000 a year to go to Boulder. And that kid can just walk in and get a loan and come out with a $200,000 loan. It's awful. How are they ever going to pay that off? And then on top of that, they can walk into a car dealer and get a car. Now they have a $400 or $500 payment or more on a car. Then you could go in the bank and get a credit card. So massive debt. We have a high consumer debt. And what that means to us as investors is that there's going to be more renters because we have an increasing population, increasing household demand. But a lot of that demand is going to come in the form of renters. So what kind? Well, we've got 16 million in single family, about 28 million in multi. If you're going to go with single family rentals, you're going to get a little bit higher income family in general, and multifamily is going to be about 10,000 lower. But there's demand for both. It's kind of it's for the opportunity zones. It's way easier with 1 to 4 units than the multifamily, unless it's hard to do it. So yeah, it's like the rise of the renter nation, and that's what we're seeing headlines everywhere. So in summary, it's important to understand we are expansion. It's the longest expansion, but not the largest by any means. So we may have a bit more expanding to go, probably at least another year. But even so, the economy is fragile because of the debt crisis and because of some of the policies in place today. So the fact that the Fed is lowering rates should give you concern because you only lower rates when the economy is trying to avoid a recession. So that's where we're at. You don't lower rates. You lower rates to stimulate. You raise rates to slow down a booming economy. So as much as everyone likes to say the economy is booming, why on earth would the Fed be lowering rates? So just keep in mind it's a fragile economy. But affordable housing is needed. And for us, what's really needed is our own retirement plan, because Social Security isn't going to be there for us. Pensions aren't, debt crisis is real. So being able to provide housing is a great way to build your own retirement and offer something to someone else. And we know that growth is headed southeast and that 10,000 baby boomers are retiring every day. So lots of growth. And they're going to go to these no state income tax states. They're not going to stay in California. It's just too prohibitive. So there it is. Now there's a whole lot more to learn about opportunity zones, but this should be an overview to decide if you would do that versus the 1031. If you decide you want to learn more, we have webinars on our website. If you go to realwealthnetwork.com under the Learn tab, there's 3 webinars. One's with Clint Coons, and he explains it in detail. We have articles there. And we may be doing a fund. I don't think so, because it's complicated, but we are helping people set up their own funds. And you can learn about that at our site too. There's my podcast where we kind of keep you up with keep you on top of what's happening in the real estate world, which is ever changing. So real estate news is just 7 minutes a day. And then the Real Wealth Show, I interview experts. I should interview you guys. You should come on my show.
Oh, love to.
Yeah, we would be very, very happy to.
That'd be great. Let's do
Love
it.
All right.
So yeah, so for everybody that's never subscribed to Keffy's podcasts, try it out. It surprises me how Keffy gets anything done on top of the enormous amount of content that she puts out. I mean, Keffy, how many podcasts do you do a year? Just the podcasts?
I mean, we do one a week for the Real Wealth Show, which is a 20-minute interview, and then we do a daily news show. But I have a team. I have a news writer I stole from Fox News. I used to work there at KTVU, and we were friends. So now she writes for us and does the research. So I get a lot of help.
Good, yeah, and you must be very organized as well then, because putting out that much content. I mean, we put out a little bit of content ourselves, and we're always surprised. We should be by now, but we're always surprised how much work it is.
Oh my gosh, it is. It's a lot of work.
Anyway, but yeah, everybody that hasn't checked out Keffy's podcast, I definitely recommend you do that. A lot of good stuff in there, and very up to date. Always. Yeah.
Thank you.
So, Ryder, do you have any closing comments?
Yeah, I think if anybody wants to ask questions, you can go ahead and put that in the Q&A or just chat it over, and we'll make sure Kathy sees that and can respond if she likes. I was super interested by the business aspect. I hadn't thought about that at all, but that's really significant. I mean, if you can imagine somebody grows a massive company in an opportunity zone and then has all those tax incentives for, decades.
Yeah.
That's tremendous.
Imagine Facebook or Google was founded in an opportunity zone.
The next one might be.
Yes. So Kathy, and we chatted about this a little bit through email, but I've looked at opportunity zones a little bit too, and what kind of scares me about it is that there's so many different things to take into account that typically when you look at real estate you don't have to take into account.
Yeah.
And you kind of came to that same conclusion too. But what I wanted to say is that there are people that are willing to take that on. And I think if you can find the right partner to partner up with, someone that's actually dedicated to, being on deck for that for the next 10 years or so, a lot of investors can still benefit from this without having to, know every comma of the new law and all the interpretations that are not even known yet. Would you agree?
Yeah, I mean, I'm on a lot of panels with big hedge funds, and they're very active in opportunity zones. But the difference is it's kind of like if you were to be an angel investor in a startup, you're probably going to lose your money. But right,
Yes,
I mean,
yes.
that's how it works.
If you just invest in one, definitely.
Right, but when you have angel investors, they invest in 20, and one of them is going to be the unicorn, so they can take the loss. So it's kind of the same with the big hedge funds that are doing the opportunity zones. They have enough money behind them, and they have one of the guys on my panel. They have 20 attorneys and 20 CPAs in their office.
Wow.
So it's not the same for someone like me to try to do that and manage it. We're just not large enough. So we might still do it. We're looking for the right deal. It has to be a really good deal. But we are helping investors do it with their own LLCs. And I think that's been tremendous because we already have these partners, like I said, in this little area in Tampa that's ready to boom, and you could buy a lot for $30,000, $40,000 and the builder's all ready to go. So there's ways to do it on your own, and you could kind of control it that way. But if I were to do it, I would do it with a large fund that has a lot of staff on board to make sure they're doing it right.
Yeah, and the project kind of has to be worth it too. If you have a relatively small project to take on that much overhead just to save some capital gains, that seems
right.
Cost prohibitive, I think is the word.
Absolutely, yeah. That's why there's going to be some winners in this, but it's probably going to be the big guys.
Yeah. So we have a question from one of our attendees, and this is a question that anyway I'll just read it out to you. They're saying, which OZ funds would you recommend? And let's make the word a little bit less strong than recommend. Let's say consider, or have you looked at, or do sound interesting.
It was too preliminary, the funds that I spoke with, but some of the things I've seen are pretty exciting. Like I said, in areas that are already good, and that's sad because that's really not the purpose.
Yeah, but it is my understanding
I'll tell you one area, and I don't remember the name of the company. I'll try to. What was that?
Oh, I was just saying, I'm totally with you there. I think there's a lot of junk out there too, that if it didn't make sense before the OZs, even though, like you said, it defeats the purpose of the OZ, but if it didn't make sense to buy it before the OZ, it's very doubtful that it just being in an OZ will all of a sudden have it make sense. That's important to realize too. So I like it that you touched on that.
Yeah. So I would be careful. There's a little area in downtown Henderson, Nevada. There's a guy who's doing a fund there, and I think it's pretty cool. They're trying to get the city's trying to get investors to buy homes for about $100,000 and turn them into fourplexes, and the city is very much encouraging that, and they're giving $100,000 tax rebate. So it's almost like you're getting the land for free. So that could be good.
These are older homes that are being scraped and turned into fourplexes, or okay.
Downtown Henderson, there's a huge initiative to make that really truly a downtown for locals who don't want to go to Vegas. So, but it's surrounded by all these little old homes, so they're almost paying investors to buy them. You could buy them for around $100,000, but they get $100,000 rebate. So
wow.
But then you got to build the fourplex.
Then you have to become a developer essentially on a project that is so small,
right?
Unless you buy 10 of them, but then it's interesting if you were already in that business, probably.
Right. Yeah. Exactly.
Yes. Do we have any other questions, Ryder?
I think that's it, and we're coming up on the hour, so. Yep. I think the last thing I'll just mention is we've got a exciting, of course, thank you so much, Kathy. This has been excellent.
This is awesome. Always love to have you on.
Yeah. And if you miss any piece of this, we'll have a recording. I'll post it in the next day or two. If you know anyone that you think would like this, of course, refer them to it as well. I think it's super powerful, and nobody explains this complex product as well as Kathy does.
Oh, thank you.
Yeah. So we've got a exciting VIG agenda. So we have next Thursday, August 1st is our, regular meetup. We're at Anchor Co-working Space as usual, and we'll cover secrets to massive real estate profits while keeping a day job. So if you want to keep your day job and still make a lot of profit in real estate, we're going to talk about that. August 9th, I mentioned at the beginning, the Tax and Asset Protection Workshop 3-day event. It's in the Bay Area here in Burlingame with Clint Coons. I'm going to be there. Chris is going to try to make it as well, so we're excited for that one.
And Burlingame is right next to the San Francisco airport, right?
I believe so.
I believe it's actually at the San Francisco Airport Marriott.
I think that's right.
Yeah.
All right. Well, I think that's it. Thanks
Good.
again. Have a great evening, everyone.
Thanks, Kathy.
Bye.
Bye, everyone.